Hi, everyone. Professor Sackett-Taylor here with another video lecture for you from Principles of Macroeconomics. This one is about Chapter 4, Market Outcomes and Tax Incidence. I'll be breaking this video lecture into two pieces. In the first half, we'll look at how we measure consumer surplus and producer surplus in order to determine when a market is operating most efficiently. In the second part of this lecture, we'll look at taxes, and specifically excise taxes and the deadweight loss they create by restricting the number of transactions that happen in a marketplace. So let's get started with the first half. Welfare economics is a subdiscipline of economics that specifically studies how the allocation of resources affects the economic well-being of individuals and as society as a whole. Welfare is primarily measured in two ways, by consumer surplus and producer surplus. Consumer surplus deals with the demand or the buyer side of the market. Let's look at an example. Suppose we have three government employees, Ron, Leslie, and Donna. You may recognize them. They need to enroll in an economics course and buy a textbook. They each have a different willingness to pay, often denoted by WTP, for a college textbook. Willingness to pay is an individual measure that each of us knows inside of ourselves. It's a maximum value that you're willing and able to pay for a good or service. And it's often based on things like income, the availability of other resources or substitutes, potentially liquidity, how much access you have to capital at the moment, and as well as your tastes and preferences. So here, Ron, Leslie, and Donna each have a different maximum willingness to pay for an economics textbook. Ron is willing to pay no more than $200 for a textbook. Leslie is willing to pay $150 and no more for a textbook. And Donna is willing to pay $100 for a textbook. If the price of that book is in the bookstore listed at $140, then who would actually buy the book? Well, the rule that we live by in general is that we will actually go forward with a purchase or a transaction only if we can buy that product for a price that is less than or equal to our willingness to pay. For this reason, only Ron and Leslie would actually participate in this market activity, because Ron is willing to pay more than $140 for a textbook, as is Leslie. However, Donna would not buy this textbook because her willingness to pay maxes out at $100, and the price of the textbook that it's selling for exceeds that. Consumer surplus is the value of the transaction itself to the consumer. It's the difference between a person's willingness to pay for the good and the price that they actually pay to receive the good. So in this case, since Ron was willing to pay up to $200 for this textbook, but only actually paid $140, Ron walks away with a textbook and $60 of value in consumer surplus. Leslie, on the other hand, was willing to pay $150 for this textbook and actually paid $140. So Leslie walks away with the textbook in hand, as well as $10 in value of consumer surplus. You might think about it like the money you have left over, as if you had saved the specific amount of your willingness to pay for something, but then actually ended up paying less for it. Donna does not receive any consumer surplus because consumer surplus is the value of a transaction. And Donna did not participate in this market activity and therefore had no transaction within which to earn or value consumer surplus. Let's use a graph to illustrate this. We have the quantity of textbooks on the x-axis and the price of textbooks on the y-axis. We're going to put in a downward sloping demand curve. And I know this demand curve looks a little weird. It has a staircase pattern. This is because we're going to represent each person's willingness to pay as a single stair in this staircase. That is the vertical height represents each individual's willingness to pay. So let's label this graph. That top stair belongs to Ron because Ron's willingness to pay for a textbook is $200. The second stair belongs to Leslie because her willingness to pay for a textbook is $150. The third and final stair is Donna's willingness to pay $100 for a textbook. In this market, there are only 3 hypothetical buyers. We could use this model for 300 buyers or 3,000 buyers. It doesn't really matter. The representation would be the same for every individual in the market. They're each representing their willingness to pay by the height of their individual stair in this staircase. If we were to look at the same demand model, but consider a situation in which a textbook costs $175, how do we calculate consumer surplus using the graphical model? Well, when a book costs $175, we only have one buyer, and that's Ron. Ron is willing to pay up to $200 for a textbook. But because Leslie and Donna's willingness to pay is below the actual price of this good, they will not participate in this market transaction. So only Ron actually buys a textbook. He was willing to pay $200, but actually paid $175. This results in $25 of consumer surplus in terms of value of that transaction to Ron. This is represented graphically as the area of the shaded in rectangle. The height of this rectangle is the difference between Ron's willingness to pay and what he actually paid. The width of the rectangle represents how many buyers are represented by that staircase or that stair in the staircase. In this case, it's just one, Ron. And so width times height tells us that $25 times one buyer gives us a total consumer surplus in this market of $25. Now let's consider the case where the price of a textbook is a little bit lower, $125. Now we will have 2 buyers. Ron will buy the textbook, and since he was willing to pay $200 but only paid $125, he has a consumer surplus valued at $75. It's the area of the shaded in rectangle here. But now Leslie will also participate in this market. Leslie's willingness to pay for a textbook was $150. So she'll buy the $125 textbook and result in having a textbook plus $25 in value of consumer surplus. Collectively, we could say that the consumer surplus in this market from these transactions is the sum of Ron's surplus and Leslie's surplus. That is a total consumer surplus of $100. Now let's look at the other side of the market, the producers or the sellers. Instead of a willingness to pay for things, a seller will have what we call a willingness to sell, WTS. This is a minimum amount that a minimum price, that is, that a seller would be willing to accept in exchange for the good or service that they've produced. So let's suppose we have 3 people who are going to produce something, Anne, April, and Andy. They opt out of taking the economics course because they already think they have enough economics knowledge, and instead they decide to go into the tutoring business and provide a service. Each individual will have their own personal willingness to sell. This is often determined by the quality of the good that you're providing or the service, what your other options are for what you could produce, as well as the opportunity cost. What is it that you're giving up by producing this service instead? So each individual has a personal willingness to sell. Andy is willing to provide tutoring services at $30 an hour. April is willing to provide them at $20 an hour, and Anne at $10 an hour. If the going market price for tutoring is currently $25 per hour, then only Andy would opt out of the market, because now, since this is a minimum willingness to sell, we would be willing to accept any price that exceeds our willingness to sell. So April is willing to sell for $20 an hour. So of course she'll accept $25. Anne is willing to sell at $10 an hour. So she'll also accept the $25. As you could see, April and Anne are going to sell their service at a price that exceeds their willingness to sell. This will give them producer surplus. Producer surplus is the difference between what you're willing to sell a good for and the price that you actually receive in exchange for producing that good or service. So here, if April and Anne both sell their tutoring service at $25 per hour, then April would have a producer surplus valued at $5, and Anne would have a producer surplus valued at $15. Let's look at this graphically. Now, since we're looking at the producer side of the market, we're going to be building a supply curve. Quantity of tutors is on the x-axis. Price per hour of tutoring is on the y-axis. We build a staircase-shaped supply curve. It's upward sloping because of the law of supply. Each person, each producer, is represented here by their own stair, and the height of their stair is their minimum willingness to accept or willingness to sell in exchange for the product or service that they have produced. The lowest stair belongs to Anne. She's willing to sell her tutoring services at $10 per hour. The second stair belongs to April. She's willing to provide her services at $20 per hour. The third and top stair belongs to Andy, who's willing to provide his tutoring services for $30 per hour. If we look at a case where tutoring is actually paying $15 per hour, then we know that only Anne is going to provide this service because this actual selling price is too low for April and Andy to be willing to sell. Anne will sell her services, but she's willing to sell them at $10 and receives $15. This gives her a producer surplus in the value of $5. It's represented here by the area of this rectangle. The height of the rectangle is the difference between what Anne actually receives and what she was willing to accept. The width of the rectangle represents the one producer who's participating in this transaction. If tutoring was to go from $15 per hour up to $25 per hour, we now have two providers. Anne will provide her services. Since she was willing to accept 10 and now actually gets 25, she has a producer surplus valued at $15. April will also provide tutoring services here. April was willing to provide services at $20 per hour, but actually receives 25. So April's producer surplus is valued at $5. Collectively in this market, producer surplus is the sum of Anne's surplus and April's surplus for a total of $20 in producer surplus as the result of these transactions. Let's practice what we know. The height of the demand curve, which is the consumer's curve, at any quantity can be thought of as willingness to pay. This is the price of the transaction, the maximum amount that someone is willing and able to exchange for a good or service. The difference between the price the good was sold at and the minimum price that the firm would have accepted is called producer surplus. Because the firm is the seller, this is the producer's side of the market, and surplus is the difference between what they were willing to do and what actually happens. So let's talk about market efficiency. When economists measure social welfare, we're looking at the society as a whole, or in other words, both sides of the market. So total surplus is the measure that we're going to look at when thinking about efficiency. And total surplus is the sum of consumer surplus for the buyers and producer surplus for the sellers. Consumer and producer surplus represent the individual or collective gains from participation in market activity. And so we want to show how total surplus is in fact maximized in markets without government intervention, as long as we can reach equilibrium. The outcome is considered efficient because in equilibrium, the resources are allocated in a way that makes total surplus as big as it could possibly be. Let's look at the graph. So now I've combined the demand and supply models into one model in graphical form. You'll notice that these don't look like staircases. That's simply because if we assume a competitive market, there are going to be many, many, many buyers and many, many, many sellers. If each one is represented by an individual stair, then those stairs begin to get very tiny and very close together. In its limit, this would result in a linear downward sloping demand curve and a linear upward sloping supply curve. Their point of intersection is what we call equilibrium. Let's put some prices and quantities in here. Let's assume we're thinking about the market for coconut cream pie. We put quantity on the x-axis and price on the y-axis. Equilibrium in this market, as determined by the interaction between supply and demand, yields an equilibrium price of $4 per slice and a quantity of 6 million slices, both bought and sold. The consumer surplus is going to be the area or the difference between the actual price that the product sells for and people's willingness to pay for that product. Remember, willingness to pay is represented by the height of the demand curve. So here, their difference collectively for all the people participating in this market transaction is the area of this triangle. The height times the width divided in half. The height of this triangle is the difference between the person with the highest willingness to pay, represented by the demand curve intersecting with the y-axis, and the true price in equilibrium that a slice of coconut pie sells for. The width of the triangle represents the number of transactions that occur. This is the equilibrium quantity. We know that this will be the number of slices both bought and sold. The area of this triangle, 1/2 the base times the height, is equivalent to the value associated with the consumer surplus earned by all the individuals that participate in this market activity and go forward with these transactions. Similarly, we can label producer surplus in this model. Producer surplus is the difference between the price that the product sells for and the individual firm's willingness to sell or willingness to accept a price for that product. Their willingness to sell is given by the height of the supply curve. And so the distance between $4 and the supply curve is going to be the individual producer surplus for each firm who sells a slice of coconut pie. Collectively, all of them will result in a producer surplus represented here by the area of this triangle, 1/2 the base times the height. The height of this triangle represents the difference between the lowest willingness to accept or sell and the true price of a slice of coconut pie. The width of the triangle is the number of transactions, the equilibrium quantity in this market. Total surplus is the collective sum of consumer and producer surplus. So here we want to consider where these things collectively are the largest they could possibly be. I argue that total surplus is maximized at a quantity associated with equilibrium. Let's do a thought experiment where we imagine that we're out of equilibrium and talk about what would happen. So let's assume we wanted to produce and sell and buy a quantity of coconut cream pie that exceeds equilibrium. Well, to the right of equilibrium are representing transactions that don't really make sense to happen, or if they do happen, they happen at a loss to people. Because we can see that if the true price of coconut cream pie is $4, then the supply curve points to the right of equilibrium all represent a minimum willingness to accept that is above $4. That is, the sellers of coconut cream pie to the right of equilibrium wouldn't benefit from accepting a price of $4 per slice. Similarly, we can see that to the right of the equilibrium quantity, the demand curve, the willingness to pay, is below $4. So those consumers, those buyers, would not be willing or able to pay $4 per slice. So to the right of equilibrium, those transactions are very unlikely to happen. And if they do, it's because someone was making poor decisions and they're not actually benefiting from going through with that transaction. So let's look at the opposite. What if we were to produce and consume at a quantity to the left of the equilibrium quantity? That is less than 6 million slices. Well, here, essentially, we'd be leaving money on the table. Transactions that would benefit people would be restricted and not allowed to go through. There are people to the right of point B and to the left of point E who are willing to pay $4 or more for a slice of pie. There are also people represented by the supply curve between point B and point E who would be willing to accept an amount less than $4 per pie. So for those transactions to be restricted or to not happen is like leaving money on the table, leaving value on the table. Those transactions bring benefits to both producers and consumers. So by not going through with them, we actually experience what's called a deadweight loss. The deadweight loss is represented by the area of this green triangle. It's all of the transactions in which people were willing to pay for the product and people were willing to sell that product. But for whatever reasons, those transactions didn't happen. And so that's a loss to society. That's economic value that wasn't added to our overall pie. So that's the first half of this chapter. Let's pause there and take the time to review the graphs and the areas, especially if you're a little rusty with the math. And the next video, we'll pick up here, looking at excise taxes and how taxes actually prevent a market from operating in its true equilibrium and result similarly in a deadweight loss. So I'll see you next time.